Disclaimer: this video is for educational and informational purposes only. The content shared does not constitute financial, investment, or trading advice. Right now, if you pull up the COMEX warehouse report published by the CME Group, you'll see a number that should concern anyone paying attention to the silver market. Registered silver inventories, that's the metal specifically earmarked and available for delivery against futures contracts, have fallen to levels not seen in a decade, not in a year, not since 2015. A decade, and the mainstream financial media is almost entirely silent about it. Most people watching silver prices on their screens every day have no idea this is happening. But the people moving real metal, the refiners, the institutional holders, the arbitrage traders, they know. They're watching that number like a hawk. And what it's telling them is profoundly different from what the paper price on COMEX is suggesting. So today, we're going to break down exactly what COMEX registered silver inventory actually means, why it matters more than most people realize, what drove it to these levels, and what happens if it keeps declining. This is not speculation. This is not prediction. This is what the data shows and what the market structure tells us when we're willing to interpret it honestly. Let me start with the basics, because understanding the plumbing of COMEX is essential to understanding why this inventory number matters at all. COMEX, as you probably know, is a futures exchange. It's where contracts representing silver are bought, sold, and theoretically settled. Most of those contracts are financial instruments. They settle in cash. They never result in anyone taking physical delivery, but a small percentage do. Maybe 5 to 10% of contracts actually stand for delivery, where the buyer says, "I don't want cash settlement, I want the actual metal." When that happens, the exchange needs to make sure the metal exists. That's where the warehouse comes in. COMEX has an approved network of warehouses across the United States where silver can be stored. These warehouses are audited, the metal is tracked, and the inventory is reported daily, broken into two categories: registered and eligible. Registered silver is metal that's been officially warranted for delivery. It belongs to someone, but it's been declared available for delivery against futures contracts. If you stand for delivery on a COMEX contract, this is the pool you're pulling from. Eligible silver is metal also stored in COMEX vaults, but it hasn't been officially entered into the delivery system. It's in the warehouse, it's been inspected and approved, but the owner hasn't made it available for delivery yet. It's like the difference between a car that's for sale and a car that's parked in a dealer's lot but has a not for sale sign on it. Now, here's the critical part. For decades, the COMEX system worked on the assumption that registered silver would always be sufficient to handle standing for delivery, because standing for delivery is rare. The ratio of contracts to actual delivery has been so skewed toward contracts that the registered inventory never really mattered. It was like asking how many parachutes are on a commercial airplane. As long as the number is above zero, nobody thinks about it, but something has shifted. Over the past 3 to 4 years, registered COMEX silver has been declining. Not every single month, but the trend is unmistakable, and it's accelerated over the past 18 months. According to COMEX warehouse reports, registered silver has fallen from levels above 150 million ounces to levels now in the range of 70 to 80 million ounces. That's roughly half of what it was at the beginning of this decade. Let me repeat that because it matters. The metal officially available for delivery against COMEX futures contracts has been cut in half over 10 years, and dramatically so in the last 3 years. And this is happening while COMEX trading volume remains elevated. Think about that math. More contracts, less metal to back them. That's a structural tightening that the paper price has not fully reflected. So the first question is, why is this happening? What's driving registered silver out of COMEX vaults? The answer is multi-layered, and each layer tells you something different about the state of the global silver market. The first driver is the most straightforward. Physical silver demand has been surging. We've documented this extensively. Solar manufacturing in China, industrial demand globally, ETF inflows from retail investors, central bank accumulation, investment demand from people concerned about currency depreciation. All of these are real. All of these are happening simultaneously. When demand for physical silver accelerates, people who own silver are incentivized to take it out of the warehouse system and use it, sell it, or hold it elsewhere outside of COMEX custody. Here's the mechanics. Someone owns eligible silver sitting in a COMEX vault. Maybe it's an industrial company. Maybe it's a precious metals firm. Maybe it's a hedge fund. An opportunity presents itself. A Chinese buyer offers a premium for physical delivery. A solar manufacturer needs silver for their fabrication. An ETF needs metal to back new shares. That owner says, "I can get a better price or better terms by selling or moving this silver than by keeping it warehoused here where it's not generating any return." So they withdraw it, they move it, they warrant it for delivery, it gets sold, and it's gone from the registered pool. The second driver is more subtle. It's about the incentive structure for warehousing silver on COMEX versus elsewhere. COMEX warehouse fees exist. They're not enormous, but they exist. There's no yield on the silver. It just sits there. A warehouse operator could store the same silver in Shanghai, or London, or Dubai, and potentially earn better terms or charge lower fees because of local demand or competitive dynamics. Capital is rational. If the return on holding silver in a COMEX vault becomes negative relative to other storage options, holders will move it. The third driver is what I'll call the voluntary scarcity effect, and it's worth examining closely. Eligible silver, as I mentioned, is metal in COMEX vaults that hasn't been warranted for delivery. Some of that eligible silver belongs to entities that could warrant it but choose not to. Think about it from their perspective. If you own silver and you believe the price is going up, or if you believe there's going to be a physical shortage, why would you warrant it for delivery into COMEX? Why would you make it available to potentially be sold at a price that may be suppressed by paper trading? You wouldn't. You'd keep it eligible but unwanted. You'd hold it in reserve. There's another wrinkle. Some eligible silver might be there precisely because it's difficult or impossible to warrant. Maybe it's a specific fineness or form that COMEX accepts in theory but rarely uses in practice. Maybe it's a strategic reserve owned by a fund or a government that will never be sold. The metal is counted in the total, but it's not really available. So when you look at the total eligible silver number, which is much larger than registered, you have to ask yourself how much of that is actually available and how much is just sitting there, claimed to be in the system but functionally off the market. That's why registered is the critical number. It's the floor. It's what's genuinely available for delivery right now, today, if needed. And that number is at a 10-year low. Now, what does that mean practically? In the short term, not necessarily catastrophic. COMEX has survived with lower registered inventories before. If standing for delivery remains rare, meaning most contracts continue to settle in cash, then the system can function even with tighter registered silver. The reason it functions is because nobody tests it. As long as the number is above zero, and as long as confidence holds that the metal exists somewhere in the system, the fiction can persist. But here's where it gets interesting. That dynamic only holds if three things remain true. First, standing for delivery remains rare. Second, confidence that metal actually exists remains intact. Third, there's no event that triggers a sudden rush to stand for delivery. What happens if any of those three things changes? Let's game out a scenario. Imagine a delivery month where standing for delivery is higher than normal. Maybe it's 2% of open contracts instead of 1%. Maybe there's been a sharp price move, and some traders or funds decide it's time to actually take delivery. With registered silver at 70 to 80 million ounces, that's still a manageable number. But what if the next month registrations don't replenish? What if instead of entities moving silver from eligible to registered, the pool shrinks further? What if registered silver falls below 50 million ounces? At that point, you start to have a situation where the headline inventory, the number that's always been there as a buffer, is no longer a buffer. It becomes a potential constraint. And the moment the market suspects a constraint, behavior changes. People stop assuming the metal is there. They demand it. They stand for delivery. They bid harder for cash settlement as a hedge. And suddenly, what was a technical detail in a warehouse report becomes a market-moving event. The precedent for this kind of dynamic is not theoretical. We've seen it in other commodity markets. We've seen it in corner attempts in the past. When a critical input becomes scarce enough that people begin to doubt availability, prices and behavior can move violently. Now let me put this in a broader context because registered silver inventory doesn't exist in isolation. It exists within a global supply-demand picture, and that picture is deeply important. The Silver Institute, which publishes the most authoritative supply-demand data for the silver market, has documented that the global silver market has been running a structural deficit for several consecutive years. That means the world has been consuming more silver than it mines and recycles, not by a tiny amount, by hundreds of millions of ounces. That deficit has to come from somewhere. It comes from above-ground inventories. It comes from strategic reserves. It comes from warehouses. And yes, it comes from COMEX. So COMEX registered silver is not just about COMEX. It's a window into a global supply picture where inventory is being drawn down year after year to meet demand that's not being met by new production. At the same time, new mine supply has been flat to slightly declining, and the pipeline for new silver mining is thin. Silver is mined mostly as a byproduct of copper, lead, and zinc. You can't just open a silver mine when the price goes up. It takes years. The investment decisions for silver mining capacity are made by copper miners and zinc miners for copper and zinc reasons. Silver comes along for the ride. So you have a situation where registered COMEX silver is declining, global supply is struggling to meet demand, and mining capacity isn't expanding. That's a convergence of forces all pointing in the same direction. Tighter, tighter, tighter. Now the question I want to address directly is this. Does this necessarily mean silver prices are about to soar? And the honest answer is no. It doesn't guarantee that. Markets are complex. There are countervailing forces. A sharp recession could destroy industrial demand. A stronger dollar could suppress prices. A liquidity crisis could force forced selling. These things happen. But what the declining registered silver inventory tells you is that if the price does move, if physical demand presses on supply, if any of the other mechanisms I've described start to amplify each other, the margin for error shrinks. The system becomes more brittle. A supply shock that might have been absorbed easily when registered silver was at 150 million ounces becomes much harder to absorb when it's at 70 million. So what should you be watching? First, the registered silver number itself. The CME publishes daily warehouse reports. You can download them for free. Watch the trend. If registered silver continues to decline, that's meaningful. If it stabilizes, that's different. If it starts to rise, that would signal a shift in the underlying dynamics. Second, watch the eligible to registered ratio, as eligible silver is warranted for delivery and moves into the registered pool. It's like the system is drawing on its reserves. If that process slows or stops, it tells you the reserve is depleting without replenishment. Third, track standing for delivery numbers during delivery months. If the number of contracts standing for delivery begins to increase as a percentage of open interest, that suggests demand for physical is intensifying and confidence that metal is available is being tested. Fourth, watch the Shanghai premium. We've discussed this extensively, but it's worth repeating. That premium is the market telling you that physical silver is tight. If Shanghai premiums are widening while COMEX registered silver is declining, those are two signals pointing in the same direction. Fifth, pay attention to ETF flows and redemptions. If ETF holdings are rising, that's physical metal being removed from the available supply pool. If ETF holdings are falling, that could mean redemptions are being met from warehouse inventory, which would show up in declining registered silver. Sixth, track mining production and any supply disruptions. Keep tabs on Peru, Mexico, and Russia's major mining regions. Any disruption that reduces byproduct silver supply would tighten the deficit further. Finally, watch central bank accumulation data. If official sector demand for silver accelerates, that's another draw on available supply. Here's the thing about the declining COMEX registered silver inventory. It's not a prediction about the future. It's a description of the present. It's the system telling you that physical availability is tightening. Whether that tightening results in higher prices, a delivery squeeze, a shift in how silver is traded globally, or some combination of those things, I don't know. Nobody does. Anyone who tells you they know exactly how this plays out is guessing. But what I do know is that historically, when physical inventory of a critical commodity declines to decade lows, while demand remains strong and supply can't keep pace, that's the setup for significant moves. Not always tomorrow, not always in a straight line, but eventually. The registered silver number at COMEX is a warning light. It's not screaming, but it's on. And if you're paying attention to the silver market, if you're holding silver, if you're thinking about silver, you need to know that light is there. You need to understand what it means, and you need to be watching to see if it gets brighter. That's the data. That's what it's telling us. Make of it what you will. Thanks for watching. If this analysis was useful, please hit the subscribe button. I track these metrics weekly, and I'll report back when something significant changes. Until then, stay informed and stay sharp.